Hello and welcome back to another episode of Brighter Retirement Radio. As always, I'm your host, Devin Peterson, and in today's episode, I had this special opportunity to interview a good friend of mine, Kurt Brown, on the topic of the impacts of COVID-19 on our economy. I've been looking forward to this conversation for many weeks because Kurt is the best personality and individual to dive into the technical aspects of the market, but really simplify it to something that we all can understand. So Kurt Brown is currently the Chief Investment Officer of TownSquare Capital, but he comes with 25 years or more of experience working in the capital markets, starting with Wall Street. He's worked with Fortune 500 companies and endowment funds all the way down to bank trusts and individual retirement accounts. So inside of our discussion today, I want to give you a little bit of an insight into what we're going to be talking about as encouragement for you as our listeners to dive in and to listen to this full interview. My primary focus in this interview was to really have us all understand the impact that the COVID-19 has really done to our economy. And we do that by talking about first how this market correction differs from those of the past. We talk about long-term impacts, both positive and negative, that are coming from this recent market downturn, and that how this really differs from or is similar to recessions or depression. Kurt absolutely will share his opinion on the definition of those two and why it's actually irrelevant, and we shouldn't really focus on that. But the primary takeaway that we talk about here in this interview, for me at least, is to really seek to understand why the market is so volatile and how the market can be increasing while the economy is still basically shut down. So I think this episode will leave you with a good understanding of the volatility of the market, how news impacts the market, and how the market as a whole is trying to look forward to what the economy will look like, and how models really right now are coming up short. And it's so difficult to model exactly what this will look like in the future. So I'm so excited to introduce Kurt Brown and start this episode. So without further ado, here's my interview with Kurt Brown. All right, Kurt Brown, I am so excited to have you on our podcast today. And this is a conversation that I've looked forward to having for the last several months as I put together my ideal podcast guest list because of the expert background you bring working in the capital markets, but even more than that, it's your fun electric personality that really can make investments a little bit simpler for us to really understand. So thank you for joining us today.
Hey, I appreciate being on here. I understand I'm in one of the one of the prime spots on the podcast. So I honestly, I love this, and you and I don't get to hang out enough as it is. So this will be kind of fun to hang out.
Perfect. Well, I don't think that this podcast could be ever more timely as we've experienced some significant market volatility, almost heart-stopping volatility for a lot of our clients. As you know, that we work with baby boomers, pre-retirees, and retirees that are getting excited to move into retirement and start using their investable assets, or several years into retirement, they're very much aware of the urgency of how these assets support them. And so I think this conversation is very timely as we really seek to understand, is it okay to breathe? Is it not okay to breathe? What do we do next? So my goal or intention here for this conversation, Kurt, is to really tap into your experience of working in capital markets for over 25 years, seeing many declines, seeing many market recoveries, and working with the full gamut of heavy corporate accounts down to individual retirement accounts. I'm really looking forward to seeing some of the insight that we can gather here.
And let's see if you and I can solve a few of the world's problems. I know we don't have a ton of time together, but let's see what we can do.
Let's start checking them off the list.
And that is a very nice intro, and I appreciate that. I've been in the capital markets business for 27 or 28 years, and started on the floor of the New York Stock Exchange. And you kind of think, oh, I've seen it all now, like it's kind of funny. You start becoming more of the quote, like veteran guy, because you still mentally feel like a kid sometimes, know. But then you have something like this, and there's no playbook for this, right? There's no playbook for a virus that shuts our whole economy down. So yeah, we're having conversations like this, dozens of them a day, and we're all kind of in this together. So yeah. let's talk through some of it.
So obviously, just like you mentioned, you've been around, you've seen some of these up and downs. This is a bit different than what you've seen in the past. So how economically or foundationally in the market, how is this market correction different from those of the past?
And it's funny because there's been, a dozen kind of bear markets and recessions since World War II. And they've all been caused by really different types of things. And so there's no two recessions that are the same. And this is why they're so hard to predict, is that it's the thing you don't see coming that's the thing that derails you. Right? So almost by definition, you don't know. Mm-hmm. And maybe if we have time, we can talk about the flip side of the coin, which is there's also remarkable similarities to how markets respond to all of them. No matter what causes them, there's a lot of consistency. In terms of the differences, when in American history do you take almost the whole economy offline for even a couple of weeks? No matter what's happened in this country, even wars, even world wars, 9/11, right? These really exogenous events, you still aren't saying every restaurant and school has to stop operating. It's unprecedented.
Yeah.
And that's why people that are coming out and making, their estimates, this is what we think earnings are going to be this year, or GDP. We're a little early. They're guessing, wildly guessing.
Mm-hmm. Yeah. So in terms of comparing this to the past, there's a couple of different indicators that we can look at, right? It's how sharp the decline has been or how sudden it has been over the past. It's also really how it's fundamentally been affected or started really by a government order, right? This is not the market speaking for itself as far as, it was unhealthy or something like the recession back in 2007, 8, 9. It wasn't, something that was caused by something in the general market. It was literally a politician coming out and saying, stop, and you can't move forward. So it's very, very different, right?
And that exactly. And it's one of the reasons we're seeing such tremendous amounts of stimulus put into the system by the government. They feel partially responsible for the welfare of small business owners and whatnot in this country. It's something very unique. Many people are frustrated with it. There's a lot of people around this country, and we all know this, we're watching the media, that wish we didn't have this. We were back to work, right? So tensions will continue to probably rise through this. There's going to have to be some very hard decisions made in coming weeks. There has to be a balance between the human impact of the virus, how bad is it, versus the long run human impact of destroying your economy, right? And these are not easy questions. Both sides have tremendously valid arguments. The media loves to oversimplify this and make this binary. This is not binary. We haven't been here before. And so we've got to be creative in our solutions to this as an economy. How are we going to reopen? When are we? And what responsible measures can we take to reopen it? It's going to be some of the more important conversations we've had as a society in a long time.
Absolutely. Something that I've heard quite a bit on the news and in social media is, are we making the cure worse than the problem? Mm-hmm. And I think that really speaks to your comment about this being very multifaceted, kind of a complex problem that we're solving, because it's not just this pandemic. It's
right.
What additional problems are we causing because of the cure, and how does that really affect, or what kind of model can we build that so we can understand the impact of that? It's very, 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 very difficult to see.
Well, and every week we don't have a lot of time, because every week the amount of damage being done to the economy continues to surge, right? So I'll give you a couple numbers to put to this. In 3 weeks, we've had people, American workers, file for initial unemployment claims between 15 and 16 million workers, okay? To put that into perspective, the largest single week ever in American history was 695,000 claims, right?
Correct.
So just today, in 7 days, it was 10 times larger than the single week ever in history. So if every week 3 to 6 million new people are filing unemployment claims, right? Boy, that's something that can be a little tricky to rectify quickly. And so it's a week of damage and can take several quarters to get those people reemployed if those businesses are not in a position to be able to reopen right away. So yeah, we need to move. We've got to be working on solutions for this.
Yeah, and I like how you mentioned that every day the impacts of this seem to surge or compound or become more complex, where I believe some of the damage that's done is temporary, but some of it really might be lasting. So as we kind of move into like this next question that I had for you is, what do you see as the long-term effects of this, not only just the pandemic, but our economic response to the pandemic?
Yeah, it's great. I really think that we all know probably business owners that have intentionally let their workers go so they can receive unemployment benefits with the understanding, as soon as we're open for business, we're going to bring you right back. Okay. So the recovery, so to speak, part of the recovery will be very quick. And it's one of the reasons that you're seeing the stock market, for example, act so good in the last 2 weeks, because the virus data has been better than feared. And so the market is starting to think we're going to reopen the economy quicker than maybe we worried. Okay. So even though the data in real time is bad, the market's looking through it to say, but it won't last maybe as long as we feared. Now, the flip side of that is the second part of the recovery is harder. There are certain numbers of businesses and jobs that don't come back. They're businesses that have been vaporized. I already know, just in my circle of friends, 3 or 4 restaurants and a dentist office I know about, and a few other businesses, service businesses, that they're gone. They're done. They were already operating on a narrow enough margin that they can't survive this. And so that part of the recovery takes longer. So there's going to be this fierce bounce back partially right into the summer, and then probably a multi-quarter recovery to try to start replacing some of the jobs that were lost,
Yeah. And as I think through just some of the cultural dynamic that has changed in the business world, just like this interview today, we're doing this virtually. A lot of our teams are at home working virtually. And so I wonder if there's going to be segments of the market that we've never really considered vulnerable in the past, like commercial real estate. Maybe there's several businesses that have teetered with the idea of having a stay-at-home workforce, but now this is forcing them to test that model. And so now commercial real estate as a whole is potentially a part of the economy that is going to really, speaking to your long-term recovery, that's going to be a lot slower of a recovery,
right? Because
of a changing culture environment.
You got to reinforce what you're saying. Think about a few industries. Okay, how quickly are airlines going to fill up? Okay, so we're going to reopen for business. The average daily traffic is about 2.5 million Americans fly on a daily basis, okay? Right now, we're running about 100 to 150,000 Americans flying a day. Okay, we reopen. There's a couple of factors now where first of all, there's just nervousness. Remember, after 9/11, took a few months before people felt comfortable getting back on a plane or doing certain things. So there's the first part, which is just nervousness. That will probably dissipate. You eventually go to hotels and go on trips and take meetings. Okay. But then there's a structural change. I, for example, will probably on an annual basis do more Zoom meetings now going forward than I ever have in my career. I'll still sometimes go on planes, for sure.
Yeah.
So you're right. Part of it, there's sort of 2 legs to the recovery. There's getting through the nervousness phase, and I think most of that passes. Takes a little time. We aren't as nervous anymore. Realize things are okay. Sort of get things back. But then you're right. There's some permanent changes. Will people fill up cruise ships to the same degree that they have in the past? Probably not. There's probably a certain demand for that never comes back, right?
Yeah.
So yeah, you're spot on, and these kinds of things take time, and it's why you see certain stocks in the stock market doing okay, and other stocks and by the way, big names like big name corporations get just hammered down 50, 60, 70% in one quarter because there's a fear they'll never return to the same type of business that they were doing before.
Yeah, absolutely. I see that. If we try to flip the coin though, is there any positives or any good things, long-term economic good things that you see come out of this? As I look back into 2007, 8, 9, I see how the positive impact that the banking industry was able to have some good regulations and add their cash reserves into a point where I think it's actually been good for us, right? Because the banking industry is really healthy. Is there any positives that we can see from this latest market downturn? Well,
so there's two things. There's sort of economics and there's social. And you're spot on. In fact, the truth is, and this might be a touch bit of a tangent, but the truth is, if you had to go back in the last 20 years and pick 1 month to have a virus that shut our whole economy down, you may have picked March of this year. And the reason that I say is because number one, we have historically low interest rates. Number two, our banks, to your point, Devin, they have not been this well capitalized in about 35 years. There not only was higher limits to what banks had to hold on their balance sheet, banks that were going above and beyond that. So we came into this with really well capitalized banks, which is just a tremendous blessing because people have reached and panicked for cash in the last month. And the banks were ready to do it. And then with the Fed and the Treasury helping them. But there's other things. Personal savings rates are 4 times what they were in 2007. Very different than going into the financial crisis. Household net worth, percentage of what Americans are spending on debt, 40-year low. And so we as painful as it is, and by the way, employment. I mean, employment was as tight as it's been in 50 years in the US, right? Mm-hmm. So at least coming into this, we were in a good position. What if this virus broke out in October of 2008? I mean, we would have been spun into a depression that could have taken a decade to get out of, right? I mean, so in a weird sort of way, there's actually a little bit of a blessing. Okay, back to the real question you're asking, what structural changes might take place? I actually think not necessarily in business are you going to see huge changes. There's the obvious stuff. We love this Zoom thing. We're probably going to get on less planes a little bit less often. I actually think socially though, when you look at the Asian economies, they were ready for this. They were ready for a virus that can spread and wipe people out. We were not. We will be ready for the next virus, man. I mean, it's sort of like we never considered before that somebody could use a plane as a weapon to kill thousands of people. Yeah. And now, we know now, and the TSA gives me a hard time every time I walk through there. For, 20 years almost, we've been doing that, right? This is going to be the same. We are going to be ready for this next virus. We are not going to be caught flat-footed. And you look at Korea, Japan, Singapore, Taiwan, Hong Kong. These economies, yeah, they've had some cases of the virus, but they have managed this so much better. And they're neighbors with China. Yeah. And they have managed it so much better than us in Europe has. And so that's one massive thing that's going to be different going forward. So potentially new industries created, new type of companies that might help us kind of rebound out of this economy and then be able to be created to kind of protect against future pandemics like that. Like I'll give you an example. I've been traveling to China. I have investments in China back from my investment banking days. I used to live in Beijing. And so for years, I would go to China a lot. For years, when you come through the international terminal in Beijing or Shanghai, you walk through you actually walk through a scanner that takes your temperature. I've been having my temperature taken when I fly into China for 20 years. This is the kind of thing you're going to start seeing this here. And I don't know if it's today or tomorrow or exactly how this is going to play out, but we're realizing that a viral pandemic could have. And by the way, this one is not that deadly. When you look at the hierarchy of viruses, we lucked out on this one. Mm-hmm. In fact, this is a real blessing because we got a preview of what could happen, and it scared the hell out of us. So you think about some of the preparations that we're going to make and take going forward. And I think on par, that's going to be really good for the safety of our society.
And really good for us mentally to be able to step back into some of our normalcy, to be able to travel as much as we did, move around as much as we did. I don't know if we'll need a temperature reader every time we step into the grocery store or
right.
to find that same comfort, but maybe, who knows?
Yeah.
Right? So thank you for sharing. I think there's a lot of good things and opportunities that can be and always are created out of
always
situations like this.
Always. I mean, in some ways, after 9/11, our society became a lot safer. There's some inconveniences that come along with that. These Asian economies, there's some inconveniences with how they've had to handle the virus, right? And as Americans, we're not overly enthused about being inconvenienced,
Right.
And yet through painful experience, we kind of learn sometimes we need to change some things,
Absolutely. Well, one simple thing is I actually lived in Tokyo for 2 years on a service mission, and the masks that everyone wears it in America, that feels awkward. It feels uncomfortable. If they feel self-conscious about wearing that. But what I learned from my time in Tokyo is that it was actually very much a part of their culture. Even if they had a little bit of a sneeze or a cough or a scratchy throat, they'd throw one of those on there and wear it to church, wear it to the grocery store. And it was, they're not self-conscious about it at all. They understood that they're protecting others around them.
Yeah.
And that's just an ingrained part of their culture, where I had a conversation with my sister the other day, and she said, I felt so self-conscious stepping out into public for the first time with the mask that she's wearing.
Yeah.
Which is kind of indicative of what you're talking about. I think that the Asian cultures were kind of ready for this.
That's right. I'll be honest with you. Next time I get on an airplane, when I start flying again to see clients, the first person I see that's wearing a mask, I'm going to give them a thumbs up, man. I'm going to be like, thank you. Good job.
Yes.
Where before I just kind of rolled my eyes. Now I'm like, hey, man, I'm all in.
Absolutely. So that's definitely a good thing that we can learn from this. But kind of bringing it back to the market a little bit, there's a few more questions that I really wanted to ask you, because I feel like you have some good insight here, is what is the difference between a recession and a depression? Because as I've had conversations with clients and a lot of our students, their recollection is, many years in the past from many of these recessions, like you said, we've had a lot of those, back to the ultimate example of the Great Depression. And I think there's a lot of misunderstanding of what really those are, what's the difference between those two, and could this be causing a recession or a depression?
I might be the wrong person to ask because I absolutely hate these terms. I am a professor at a local university in the finance department. I tell my students all the time, terms like recession, depression, and bear market and bull market, you got to be so incredibly careful
because they're so broad. Yeah.
Well, and they mean different things to different people. Yeah. I mean, technically, a recession is any quarter any 2-quarter period where you're seeing declining growth of GDP in the United States, okay? So you could have a recession that's really mild because you get a little bit of back-ticking to the growth rates, negative growth in this country, right? You can have recessions without a bear market. The stock market might not care that GDP, our economic output, had a little shrinkage to it. Like you might, take bear market, for example, right? Technically, a bear market is when the market drops from its high water mark down 20%. Okay, well, twice in the past 12 years, we've had drops of 19.6% and 19.8%. And so technically, we didn't have a bear market. So then people run around on TV and they say, oh my gosh, it's the longest bull market on record. And then what did they do? They kept people from making good investments because they were sending the message, the market's too expensive. When really we had 2 bear markets in there, right?
And the only separation was as a technicality on the exact definition of it. Yeah.
You got it. And so the recession to depression is sort of the same thing. It depends on who you're talking to. It's a little bit in the eye of the beholder. But if you go multiple years over years with negative economic growth, now technically you're in a depression. I don't know what to call any of this other than to say it sucks when our growth goes backwards.
Yeah.
There are economic forces at play constantly, and then the markets are representing the greed and fear tug of war around what that information is. And that's why these things kind of drive me crazy. So I don't know if that's helpful, but I think it's important for people not to get too hung up on the terms, because let me give you one other stat. If you go all the way back to the Great Depression and you look at every technical recession, okay, and it's normal to have a couple of recessions every 10 years. That's kind of normal, okay? And a little shrinkage to the economy every 10 years is totally normal. Get it happen a couple times. The stock market has always, 100% of the cases, bottomed before the recession is over. 100% of the time, okay? By an average of 5 months, the stock market bottoms before the recession is officially over. But so many people have talked themselves out of making good investments because they think we're in a recession. So they automatically in their mind think it's off the table. So if you ever go back in US and European history and you want to make investments in stocks, you actually should be making them in the recession.
Yeah.
Because that is the best opportunity to be buying. Your returns going forward are almost twice as much as buying stocks in any other normal year. And so you got to be really careful with the characterization of this. Opportunity is actually being created in the recession. That's when opportunity gets created. So yeah, I got a little bit of a chip on my shoulder about some of the terms.
I can tell. I like your spice that you added to that comment. Thank you. Well, I love that, because it kind of leads into this next point that I wanted to ask you is, have we hit the bottom yet? And can the market grow while the economy is still shut down? And the reason why I ask this, we have a lot of people mentioning, obviously the market had a steep decline, then it hit a low, and then it's been kind of rebounding in the last couple of weeks. However, the economy as a whole is still primarily shut down, and it will be for the next, who knows how long. So how do you, from your capital market experience, how do you kind of read that, where naturally the government is stepping in and infusing a lot of cash into the economy, a lot of these for the small businesses? There's a lot of positive talk on the news, and that's what's causing some of this optimism. But is that really the bottom? And what can we grow if the economy is still shut down?
It's one of the most important questions you can be asking. This is an imperative conversation to have for anybody that owns stocks and bonds. And here's why. Take, for example, today's Thursday, last Thursday, okay, both Thursdays, there were over 6.5 million new jobless claims announced to the country early this morning before the market opened. Market's up very nice today. Last Thursday, it was up huge. And my phone is blowing up with people sending me messages saying, how on earth can we have millions of new unemployment claims and the stock market goes up? How's this possible, right? Okay, the answer is in this. Think about a few weeks earlier. The stock market from February 19th to March 23rd dropped 33%. 1/3 of the biggest market in the world got clipped in just over 3 weeks. It's unprecedented. There's no bear market in history that's ever come close to dropping 30% in 22 trading days. It's the ferocity, just the fear, the ferociousness of the selling. I've only seen it about 3 or 4 other weeks in my career in 30 years. Okay, so when the news actually comes out, we have already priced into the market a tremendous amount of fear. Because when the market was diving 33% in 3 weeks, we had no news. We had no unemployment claims yet. We were completely guessing how bad this was going to get. And there has a tendency to be in all markets a sell first, ask questions later mentality. So it really is confusing for people because the first leg down is always ferocious. My mentor in New York used to always say to me, markets take the escalator up and the elevator down. Mm-hmm. And so markets just get hammered in moments of fear. But then as the weeks and months go by, we get our heads around the reality. And believe it or not, the reality of 6 million jobless claims every week for a couple of weeks was actually a little bit better than what we initially feared. Okay. And so you got to remember that the market is looking forward and is saying, what will this look like? Not what does it look like today? So that's why everybody's trying to key on when will we reopen the economy? How many weeks of this? My own personal opinion is the market is ready to be offline, have our economy be offline for 8 weeks. But boy, I do not think the stock market is ready for us to still be in quarantine in June, July, August. It is not ready for that. Yeah. And so I really believe the answer to your question about have we seen the bottom is actually more of a function of how many weeks we have to stay closed. We were prepared for some. And so the market's feeling a little bit better. The cases look better around the world. The death rates look a little better than we feared, right? So the market's feeling a little bit better. If that hooks back lower and expectations get worse again, okay, I do think you're going to see a whole nother round of volatility. Market could trade back down for a little while and maybe even go back down, to where we were before.
Mm-hmm. Yeah. I appreciate you sharing that because there's obviously for all of our listeners, we would love some very specific advice to like buy this now, sell this now, right? Yep. The details of when to do that. But I think you're right. And I appreciate you sharing that. It's tough for us to see the level of the market and think that is the bottom or this is the top, and then make investment decisions based off that.
Yeah. And you never know. And honestly, this last month has exhibited every single hallmark of massive market bottoms in market history. It mathematically, that very easily could have been the bottom. We saw tremendous panic and fear. We saw the highest VIX readings ever in history. We saw billions and billions pulled out of the market in a 2-week window. That's tremendous fear. Mm-hmm. We saw erratic and emotional trading. There were mornings that I saw big cap stocks moving in $10 increments within a few minutes. It's pure hysteria. And those are always the hallmarks of market bottom. We saw it in 08, we saw it in 9/11, we saw it in 97, 02. You just keep going back, 82, 74. That is the hallmark of market bottoms. Now, no one exactly knows when, but for people that want to make investments, you have to be disciplined enough to say, number one, I will not pick the bottom. Accept it. I will not pick the exact bottom. Nobody will. Number two, I'm going to do nibbling in great assets through the chaos. So I personally have an amount of cash I want to invest through this COVID crisis. I think it's an opportunity, okay? Yeah. Of the amount I want to invest, I've only invested 30% of it so far. So I've got this new cash. I didn't buy enough down there on March 23rd, but I bought some. And I bought some on March 17th, and I bought some on March 29th, right? You have to be disciplined enough to nibble when you see those kinds of opportunities. Truthfully, last few days, I haven't bought anything. We've had this massive bounce, and I'm trying to digest now how bad is this going to be. So I'm being a little bit patient. I at least bought some, and now I can be patient. But it's a real sucker's game to try to identify when and how bottoms are exactly going to happen,
Right. Would it be fair enough to kind of look back with certainty and know that we were at one point and now we're at here? So at any point, if you do invest new dollars into the market, at least you're kind of looking with certainty. This is where it was. This is where it is now. And in the next couple of years, it's got to go back to at least what it was before, right?
Yeah. And there are certain companies. Here's what ends up happening. In times of panic, and we saw this a couple of weeks ago, everything gets thrown out. Everything. There's something we call correlation in our business. It's a mathematical computation of the movement of all assets and how correlated are they in their movement. And when you get to 100% correlation, it's only happened you can count on one hand in 100 years when that's happened. And it happened here 2 weeks ago. What you're saying is investors are not discriminating between the quality of anything. They are throwing everything out. So from the best companies in the world to those that will file bankruptcy this year, they're throwing them all out. Okay, in that moment, if you and I had a whiteboard and we said, what are the best brands in the world? And how often do I get to buy those on sale? Okay, even in oil, even in hotels or airlines, there's opportunity that gets created in there. And now it behooves us to say, I have to just buy the best of breed assets. I don't know these junky companies, they're lottery tickets. Some of them might survive, but I don't know, right? Wow. So when in doubt, you buy really high quality and you nibble. And you just know, if you and I, Devin, had dinner together tonight and we said, and I asked you, give me 5 days in the last 100 years you wish you could have bought stocks. You would have given me October 29, October 87, November 08. Like that's what you, and I would tell you March of 20. It exhibits all those characteristics, right?
Yeah. Awesome. Well, Kurt, this has been so insightful as we've gone through this. I just have a couple more questions.
Sure.
And I know the questions up to this point have been specifically like investment, capital markets, equities heavy. But taking a bit of a more comprehensive look at those that are in retirement or planning for retirement. I know you've kind of been in the more behind the scenes of the investment world, and now you're a little bit more part of a comprehensive team that's working directly with investors and advisors. But from your perspective as a chief investment officer, what are some of the benefits of folks having a plan and working that plan, sticking to that plan?
Oh man, I've been talking about this every day for a month. And let me sell against myself a little bit. I'm an investment. I've spent my whole life building portfolios and overseeing assets. But here's the thing: the truth is, I'm not the actual important guy in the process. I'm going to give you a stat that sells against myself. Okay,
I'm excited to hear it.
Of all retirement plan returns since the Great Depression, 70% of the return has been about being invested at all. In other words, if you pick the worst funds and the worst investments, you still made 70% of the return if you just stayed invested, right? So my point is that the plan is everything. And we oversee about $5 billion in total assets. We've got a couple of billion at Schwab and TD Ameritrade and some of the big, brokerage houses, Fidelity. So I talk to them on a weekly basis, and I really want to know what is going on. What are investors doing? And we haven't seen a lot of clients panic. I've seen very few call and say, okay, take me to cash. A few. I mean, it's normal, but not that many. But the people that have their brokerage accounts themselves at Schwab and Fidelity, they've seen massive numbers of people clicking buttons, sell everything in my account right now. I just this morning talked to somebody at TD Ameritrade, a very senior person there. Almost everybody that has done that in the past month, the market is much higher now than where they did that at, right? Mm-hmm. So if you don't have a plan, the emotion of a moment will hijack what you do, because good planning lets you sleep well at night saying, these assets are under stress right now, but it's over here in bucket 3 or bucket 4, my long-term, really growth-oriented money. I've got this other part of my plan that allows me not to worry about the next few years because I've taken care of those things. And it's why I'm such a big fan of people having advisors. For example, we don't take clients directly at my firm for this reason. They have to work with an advisor to build a plan because no two people are the same. In fact, when somebody grabs me in my family or my circle of friends and they say, hey, you're an investment guy, what should I do? I just laugh. And I don't answer. I say, you need to create a plan. I can't tell you what you should do, right? I mean, the most dramatic examples I can give you. I have a 95-year-old client in San Francisco. He's been a client of mine for 20 years. The guy has never owned a single bond his whole life.
Incredible.
It's a badge of honor. He's 95, and it flies in the face of every financial planning book you've read that he would own nothing but the highest growth assets on the planet, this guy. And you know what? It's perfect for him. All of that money is going to go to his heirs. He doesn't want to bury them in a bunch of conservative treasuries and things like that. Okay, we got a 45-year-old client out here in the Mountain States. 45 years old. Doesn't own one stock. This guy owns all muni bonds. This guy cannot handle the volatility of the stock market. He takes tremendous risk in his day job as a tech executive, and all his money's in munis, and he sleeps really well at night. And I can't talk him into buying a stock, right? So everybody's plan, there is no imperative right or wrong. There's tools in a toolbox, and then you got to use those tools to sort of build what you need. So yeah, I literally cannot stress this enough. Can I give one other stat on this, Devin? Do we have time?
Yeah.
Okay. If remember Y2K? Remember 12/31/99? We weren't sure if the planes were going to fall out of the sky or if computers were going to explode on our desk. Okay. If you got up the next morning and you put $100,000 in the S&P 500, and this last December 31st that we just had, 20 years later, you sold it, your S&P 500, index fund, whatever. The $100,000 turned into $325,000. Okay, pretty good rate of return. In there, we saw two massive bear markets, the 02 dot-com collapse and then the 08 financial crisis. And you still did 325% return. Not bad. Okay, if you just missed the best 10-day window in 20 years, you have half the money. You have $162,000.
Are those 10 consecutive days, like a window? Yeah, that's not like separate. Just
window. You can't miss that window. And here's what surprises people. Of all of the 20 best single days in U.S. market history, 17 of the best 20 took place while the market was down more than 20% from its high. In other words, in a bear market are 17 of the best 20 days. We've seen 3 of the best 20 in the last 2 weeks.
Wow.
So think about if you sold 2 weeks ago. Now you're really stressed because you're like, okay, the market bounced 24%. Now what do I do? Do I go back in? Like, it's a head game. And that is why you absolutely have to have a plan in place that prepares for things like this. It's still stressful. It's stressful for all of us. But the plan will save you from yourself.
And I appreciate you sharing that it's an individual plan. And a couple of examples that shared were, these clients are at two ends of the spectrum. That their goals are completely different. They're two different ages, but it does take the emotion out of it. And so for all of our listeners that are concerned and worried about their finances and stressed about what the market it is, and they're checking the stock market every day, having a plan really takes that emotion and calms it down. Gives them some peace of mind or a green light really to move forward and live life according to your plan, because that's how it was set up from the very beginning. So
that is
so much for kind of bringing it back home to that.
100% accurate. There's all this chatter. I got to have the 60-40 portfolio or the 70-30. That's ridiculous. You need a portfolio that represents your objectives, your risk tolerances. And, like a guy used to say to me all the time when I traded in New York, he used to always say, when in doubt, sell down to the sleeping point. If you're losing sleep at night, you probably have the wrong portfolio. You got to call your advisor and say, okay, hold on, we got to talk this through. This is why we have good advisors.
Right. Nice. Well, Kurt, I know this has been a big part of your valuable time, and I absolutely appreciate you joining us here on this podcast. Before we finish, however, I do want to ask you more of a personal question.
Okay.
This is a question we ask for all of our listeners because I'm genuinely interested in the human connection. I feel like that people connect with people, not with businesses or anything other than just real human connection. So
I'm scared of what you're going to ask me. How many hours a year do I spend being interviewed? And no one ever wants to ask me a personal question. Now I'm scared. Maybe my wife should answer whatever you're going to ask me.
Well, here's my question, because I do care about you personally. I think that this this answer will kind of show all of our listeners that what's underneath the skin of Kurt Brown. So for you individually, what makes you feel alive, number one, and what makes you feel relevant in your life, the life of your family, life of your business? What makes you feel alive and relevant in your life?
Well, the answer to this question is funny, has really evolved over the years, which I think for most people, I would hope, as we mature, it sort of evolves. I was a workaholic for a lot of my early years through my 20s and 30s. I'm almost 50. I got married finally, and I have 3 kids under 6.
Wow.
Including 2 adopted children. My wife and I have done in vitro 37 times. And my appreciation and joy over being a dad is so far past what I ever could have anticipated. It wasn't necessary. I mean, I kind of always thought maybe I wanted to have a family and have kids, but didn't necessarily ever feel a burning desire, and now there are moments where I think I almost missed this. I just about, with a couple of other dumb decisions, I would have missed this, and so, all the success that I've had in my career, and as much as I've enjoyed my career, once I held that first baby in my hands, in that delivery room, all of it just paled in comparison, and I know all your listeners that are parents know, what this feels like. But for me personally, the fact that it's been so hard, it was so hard to get married. It was so hard to have kids. It was, oh my gosh, there are very few moments that I take it for granted now. So for that, I'm just tremendously grateful,
Thank you. Thank you. As we have this conversation about COVID-19 and all the different cultural dynamics that it's added to us, if we can add that one positive impact to all this is it's brought us home a little bit closer to our family, a little bit more time with our children, because we've been forced to. And sometimes, frankly, God kind of has to punch us in the face and say, focus on really what's important. So Kurt, thank you so much again for joining us here today. Conversation has been extremely enjoyable for me personally and in my profession. And I hope that it's been the same, or I'm sure that it's been the same for our listeners. So thank you so much.
Hey, thanks for inviting me. I'm happy to come back anytime. It's fun to hang out with you, man, even if it's in a Zoom room.
I know, right? Let's make it face-to-face sometime. All right. Thanks so much.
We'll see you, buddy.